Welcome, everyone, and thank you for attending today's SOVOS Tax Transformation series on Tech Automation, a Driving Force for Tax Compliance, hosted by SOVOS. Before we begin, we wanted to cover a few housekeeping items. At the bottom of your screen, you will find multiple application engagement tools that you can use. All engagement tools are resizable and movable, so please feel free to move them around to get the most of your desktop and laptop space. You can expand your sliding area or maximize it to full screen by clicking on the arrows in the top right-hand corner. Today's webcast is being streamed through your computer, so there is no need to dial in. For best audio quality, please make sure your computer speakers or headsets are turned on and the volume is up so you can hear the presenters. If you have any questions during the webcast, you can submit them through the Q&A engagement tool. We will try to answer this during the webcast, but if a fuller answer is needed, or if we run out of time, it will be later answered by email. A post-communication email of today's slide deck and recorded webcast will be sent to all registrants at the start of next week, so please keep a lookout for this. And now I would like to introduce you to our presenter and leading expert, Philippa Jonsted, Senior Regulatory Counsel at SOVOS.
Thank you very much. Welcome, everybody. I'm happy to walk you through what we at SOVOS believe is a seismic shift in how businesses go about their financial processes, their accounting processes, and their approach to tax and government control. Right now, what we're seeing is extensive tech automation going on. Businesses, such as yourselves and many others out there, have been undergoing technical automation in many different ways over the past few years. But governments are doing it too. And the way governments are going about business automation has a significant effect on the potential automation that companies out there do their business. So that's what we're going to talk about today, and how this transformation has the potential of either becoming something that hinders your digital transformation, or more importantly, as something that you can use to leverage your own digital transformation agenda. So we're going to start by taking a look at what is going on. How does tax and ID correlate in terms of, and work together in terms of technical transformation? Is this a vicious circle that we're seeing for government transformation upheaving your transformation agenda? We're going to take a look at how tax transformation, the government agenda, is a problem for many businesses out there, what's going on, what the trends are, and what we've been seeing, as well as how we can take this digital transformation that governments are putting in place and turn that into something that you can use as part of a solution to staying compliant and to getting your agenda in place as well. So let's get started. First, let's take a look at this vicious circle, or I'd rather say Gordian knot, that sits in front of us. We've had several surveys out and been involved in understanding what both IT directors and tax directors out there find to be their substantial challenges in finance, IT, and tax in the future. And many of you indicate clearly that migration into new versions of ERP systems and SAP systems is a big concern. But what most tend to indicate is the diversity of country-specific tax, indirect tax requirements, and how they are disrupting your technical roadmap for automation. Now, there are many different challenges out there that companies, tax people, and IT people are facing. But what all of this has in common is that you're acting and reacting in a world with limited resources. It's the reality of any company out there today and tomorrow. Businesses and resources aren't infinite. We need to do the best with what we have at our disposal. So let's take a closer look at what's going on to see how you can use this challenge that has been highlighted as the biggest one, namely the push to comply with upcoming tax digitization reform, and to leverage that so that you get the biggest value for money, the two birds in one stone, the biggest bang for your buck, as you are rolling out new IT change initiatives. So what many companies out there today are facing is a Gordian knot of problems. When we talk to large multinational and people who are describing what their biggest point of friction and what their biggest problems are today, they tend to say that bad data is the biggest process problem and hindrance for them on their digitization and automation journey. But bad data typically comes from something as simple as manual processes. And manual processes is something that not only feeds and requires or ends up with a result of poor data, but it also forces taxpayers into a situation where when a mandate or a significant tax control reform happens in a given country, that they are forced to source local point solutions to meet the deadline in that given country. In Latin America, for example, we've seen country after country go about introducing substantial reform that affects business processes and operational processes alike. And when companies have been processing their data through manual processes and increasingly with friction in all of this, they have indeed been ending up in a situation where as each single country introduces a new mandate, because of this reality, they haven't been able to automate to the extent that they've wished. They've instead gone and bought a singular solution in countries to meet the deadline ahead of them. So what does that mean? Well, that means that you miss another automation opportunity, because when a mandate struck in Mexico and a new accounting document needed to be cleared by the tax authority in real time, you weren't able to automate because you needed to spend that IT budget on buying a local solution to meet those requirements. And ultimately, what does that lead to? Well, it means that your manual processes remained where they are from the beginning. There hasn't been any progress. And ultimately, at the end of all of this, you're still stuck with the problem that you had from the beginning, just less budget because you've spent it on local solutions. And as a result, you risk being in a situation where your competitiveness is reduced, and above all, also your resilience in times like these because of lack of automation. There are many things that we've learned over the past months and the reality that we're all sitting in right now. But one key lesson is that the more you automate, the more you are ready to handle processes that don't rely on manual intervention, the better suited you are to handle these kinds of challenges with resilience. And interestingly enough, you're also better suited to handle the other many challenges that we as companies will be facing over the next few years. Many companies will be forced to migrate to new ERP systems. S/4HANA is just a few years away. And the pace through which governments are imposing new continuous control regimes is just increasing. But we believe that there are better ways to go about this. Our thesis is that tax reform can also be used as an advantage. It can be used as a catalyst for positive change. So if you instead use this time ahead of us right now to automate compliance, to automate transactions, even in countries where continuous transaction controls and continuous clearance and continuous reporting to government entities isn't mandatory, you will be in a better position for when they strike. If you do it already now, and where we have this great, I'd say, blank slate ahead of us in most of Europe and Asia, Latin America having already gone through this transformation a few years ago. If we do it already now, before these mandates hit, we'll be in a position to where we can transform, process, and populate good data that is in much better shape because you've spent time, resources, and effort putting it into shape in this time right now. That, as a result, the fact that you have much better data at your disposal means that you can do a migration to a CTC reform on your own terms. It will not be a panic fix, it will be controlled, and you'll be able to put better requirements on your vendors and on your solutions. You'll also be able to maximize automation opportunities that lie ahead. And ultimately, as a result, you will be at a better place to automate compliance when new reform happens. So in addition to just being ready for the next big tax reform, you will have automated financial processes and be in a better, more resilient position, and also in a position to facilitate a smoother migration to new ERP systems and financial processes as those deadlines come closer. So if we instead take a closer look at what's going on in the world of digital taxation and digital tax controls. What exactly are governments out there doing? What is the trend that we're seeing? And how is it right now becoming increasingly of a problem? We're going to spend a little time taking a closer look at that before we go into seeing what we can do about it as the solution. So the first trend that we always think is worth highlighting, and if you've heard me speak before, you'll have heard me talk about this slide, because I think this sits at the core of what what taxpayers out there in the world are struggling with right now. Traditionally, companies, tax compliance teams, AP and AR teams have had their hands full with what we call traditional tax form filing. It could be paper, it could be electronic, doesn't really matter. The principle is the same. Within a certain time interval, you as a financial team or a tax team are required to submit reports and records of what you've transacted, how much VAT is input, how much VAT is output, so that the government gets a good indication of what the balance is. But gradually, we've seen companies and countries approach this in a different way. Up here in the top corner, you'll see Chile leading the way. Now, Chile is a pioneering country in this regard and has been live and kicking in their reform for, I believe, since roughly 2003. So it's not weird that it sits up there as a clear, I would say, leader in this area. It's because it, as a nation and as a tax reform system, has had a lot of time to get this sophisticated. The key difference between Chile and a country that still is doing paper or web form traditional filing is, of course, that Chile and its so-called continuous transaction control system has inserted itself into the trading party process, meaning that a supplier cannot issue an invoice without the government seeing it in real time and okaying it in one way or another. There are, of course, variations between this. Not every country is quite as sophisticated in this regard as Chile. In Europe, for example, we've seen a slower move in that direction, with countries such as Hungary requiring real-time e-invoice reporting. So it doesn't change the validity of an invoice. You still need to issue your invoice in your own way. Doesn't matter really how, but at the same moment as you issue the invoice, you need to send that data to the tax authority. They want real-time visibility into your records. Whereas other countries such as Turkey, Mexico, Italy, and Brazil sit somewhere in between there in terms of complexity and have imposed an e-invoicing regime. Of course, this is just one trend. Another significant trend that is increasing in importance and happening right now worldwide is a shift in terms of taxation, from an origin-based principle instead to a destination-based principle, which has significant impact on tax and finance teams, because historically you've needed to have a very solid understanding, a crystal clear understanding of the tax rules for where you operate, but not necessarily outside of that jurisdiction. Whereas as a result of what we are doing in our shifting consumption patterns and our shifting sales patterns, governments are increasingly also wanting to make sure that they get tax revenue when their local citizens are consuming goods that are produced from elsewhere that they cannot touch. Now, this is something that, of course, stands out, especially for e-commerce providers, but not only. It will have significant impact for our tax and finance teams worldwide. And the last trend is that I want to highlight today, I would say, is a merge of the previous two. As a result of compliance responsibility shifting from after the fact kind of approach in terms of reporting to a real-time approach in the middle of a transaction, as well as a shift in the principle of who's being taxed, means that tax authority are increasingly placing their focus not only on suppliers and buyers, but on aggregators of the invoicing processes and aggregators of the sale itself. I would say that this is a clear-cut distinction, meaning that even if e-commerce platforms also here perhaps sit at the core of this new obligation, it means that any type of platform these days will see a shift to having to comply way more than before, not only with e-invoicing obligation, which is a shift that we've been seeing for many years now, but also to have a much better understanding of the exact and precise tax applicable to a given transaction and who pays it, as well as also a continuous reporting obligation, both periodic and continuous. So who does this affect? Well, as I mentioned, it targets especially e-commerce marketplaces. That is a given in this scenario, but it also goes beyond that. For example, payment service providers is a category of companies that are coming increasingly under scrutiny by tax authorities worldwide. And it makes sense, of course, why, if you're shifting to a destination-based principle, why would you try to get a tiny supplier in a country that you might not have super close mutual tax assistance cooperation with to pay when you can get MasterCard to pay, as is the case, for example, in Argentina? Another type of category that is coming increasingly under scrutiny are also express carriers, the UPS and FedExes of the world, because of their role in global supply chains, B2B networks as well. It's not just business to consumer e-commerce marketplaces that are under scrutiny, far from it. B2B networks are also coming under scrutiny. And as a result, also multinational companies, because many companies out there have effectively set up some very sophisticated, some fairly basic supplier and buyer portals, whereby they aggregate invoice data, handle financial processes on behalf of their suppliers or buyers. So it's not an uncommon landscape out there today to see large Fortune 500 companies to effectively have complex portals available at their disposal, through which they are onboarding both suppliers and buyers. So for those of you who aren't very familiar with this term that I keep throwing around, continuous transaction controls, I wanted to take you through the basic orchestration. Now, there isn't, I would say, a CTC system that is a copy-paste of the other one, unfortunately. Tax is a sovereign matter, it's a national matter, and while there is cooperation, of course, no tax authority is willing to entirely compromise when it comes to the one type of data that they want to collect and the kind of process they want to orchestrate, because they run on the principle of what is best for the businesses in their country that, of course, they have the best view into. So it makes sense, even though it's frustrating for businesses to comply with. But in a nutshell, a continuous transaction control system or a clearance system, to simplify, could look a lot like this. If you are a supplier, you want to invoice one of your customers for goods you've sold them, you first need to, in a structured form, send this invoice to the tax administration, often through a centralized platform, sometimes run by a third party, sometimes run entirely by the tax administration. What you get there in some countries is a de facto okay or not okay message. Sometimes you don't get anything back. But the point is the tax administration sees this in real time. On the buyer side, again, depending on sophistication of the country in question, you will need to be sure that you are indeed processing a tax administration approved invoice and that you're not paying something else. Because in the eye of the tax administration, unless it's something they've seen, cleared and registered, it doesn't exist. It has zero fiscal value, which means that you are increasing your exposure for accusations on VAT fraud. So it's very, very important to have buyer-side processes in place in clearance countries. And of course, we're also seeing, as I've mentioned, a great fragmentation in what these systems look like. And often they have clear regional components. I've already mentioned that Latin America is the birthplace of what we call clearance e-invoicing, pioneering CTC control worldwide. Often these countries don't regulate the delivery, but there is very structured clearance orchestration. In Europe, for example, the go-to method has long been reporting, but it's through exposure to clearance countries and through the great success story that has been clearance rollout in this region, they're increasing the granularity, they're increasing the tempo so that real-time reporting is effectively inching towards clearance systems in terms of ambition. Also with clear components of making these types of requirements mandatory in public procurement processes. And in North America, for example, public procurement as well as standardization have been key flavors. We'll have to see what directions the tax administrations in these countries will go to. And I'd say that Asia is now the region ahead of us that has the greatest spread in terms of what type of flavors they have in their CTC regimes. Right now, there is a preference towards what we call owning the network, and I'll explain more what that is in a bit. But of course, the clearance element, again, that originated in Latin America is the model on which Asian tax administrations are also designing their processes. So when we say owning the network, what do we mean? Well, it's the next level evolution of a continuous transaction control system. Now, a classic model, the typical Latin American models, leave the delivery of an invoice to the trading parties. All they want is structured data, clear visibility, and some of them, like Chile, for example, regulate the buyer-side processes much more granular and sophisticated way than others. But in newer CTC models, and this isn't just an Asian approach by any means, Italy being the first European example of such a reform, went down this route as well, clearly inspired by a Turkish model. In these countries, the CTC platform is inserting itself in the delivery model, which means that you cannot really opt out of the government delivery between trading parties. So if you are receiving inbound transactions in a clearance system, it becomes very, very important to adapt your buyer-side processes so that they fit on top whatever the government has decided to put in place as a CTC orchestration. And given that many Asian countries, and not just Asian, also in North Africa and the Middle East, we're seeing a clear preference for this type of model because of the benefits they believe that it brings to small and medium-sized businesses. And of course, these systems have impact to various degrees on businesses. Historically, if in a traditional VAT report and VAT compliance system, if there are any mistakes, the result is often a financial problem. It's a fine, put simply, and it doesn't affect the way you run your business. It doesn't affect your operations or your supply chain. But the more sophisticated a CTC system, the more it risks impacting your processes. In countries like Brazil, for example, problems with invoicing processes means that your trucks across state lines are stopped. They cannot cross state lines unless they have valid invoices and valid transport documents that have been cleared by the government layer, which means that the the impact is more than just something that affects your financial systems and your financial processes. It affects the way you go about your business. And where is this going then? If we take a step back and look at the world from a bird's eye perspective, is the situation quite as significant as I'm describing? Well, I'd like to think so. We're coming from a world that on this map was entirely grey. Post-audit, meaning that tax authorities reserved the right to come and look at your records and look at your processes, but didn't impose any guidance or rules as to how you go about your processes, to a CTC world, which slowly but surely is taking over more and more of the world because of its key benefits for tax authorities. And that benefit is the same benefit that is driving business automation, and that's good access to quality data. So the question then becomes, how do you go about surviving this chaos that is the rollout of CTC regimes? Well, regardless of what type of regime is being rolled out, whether it's e-invoicing or whether it's periodic reporting that is becoming gradually more and more complex and sophisticated and frequent, the road is going towards continuous transaction controls. And the more you can do today to already automate and put in place processes, clean up data, the better you will be suited to handle when the next CTC reform strikes. Unfortunately, what most businesses that we talk to describe is a situation that isn't quite in line with what I described. As regulatory change accelerates, you saw the world map, so does the pressure on IT departments and tax departments to meet that deadline, whatever the cost may be, because the consequences are so significant. And ultimately, that means that most companies out there tend to go about resolving this by buying local solutions and outsourcing their processes to local providers, where there is no possibility for recycling the same process over multiple countries. Now, why is that a bad thing? Well, it is a bad thing for the reason that it takes your automation journey not one, but multiple steps back. Essentially, what happens is that the implementation of multiple and local point solutions creates a situation in which you have duplicate functionalities in different countries. You'll have one system that is more or less identical to another with minor adaptations in different countries. But because you have put them in place bit by bit, you haven't thought about it in a strategic way. What that in turn means is that you'll have a setback in B2B automation and not meet the goals that you set out to meet on your IT digitization journey. These opportunities are not just lost, but they also cost. The digital transformation journey, your roadmap still remains unchanged, but you will have paid into compliance multiple times and lost an opportunity to transform. And of course, managing multiple vendors mean that you have costs associated with that as well. Costs in terms of legal, SLAs, and simply keeping it all operational. The risk with doing this is also quite high. Each vendor will always have different security commitments, different liability commitments, and different SLAs when it comes to matters like uptime, throughput, support, and so on. And often what companies complain about is the fact that when these mandates hit with short notice, it's often a market of compliance providers or solution vendors that seek to meet these requirements that are new and fresh and have fairly unproven track record. We believe that there is a better way. Instead of falling to the pressure to use local disparate solutions that ultimately reverse the digital transformation journey that businesses are on, and in turn leading to increased costs and both for IT rollout and compliance, you can instead leverage this change journey that lies ahead in terms of compliance to adopt a modern global strategy for how to tackle VAT reform that supports the digital transformation journey that you want to do to increase your business automation agenda in a way that you stay in control of costs and compliance. So now let's take a look at how we can do this. How can we use tax as part of the solution, and what are key points to keep in mind for different parts of your business? Now, this is a slide that seeks to describe a typical large company, a multinational company of a certain size, and the different processes and challenges it faces. So at the core of this, we have ERP and other backend systems. I'd say that put yourselves here in the middle because this displays your financial core. At the outline, we have your AR processes, your AP processes, as well as fringe systems of your trading parties. And at the very bottom, we have tax administrations, which is why we're having this conversation to begin with. How do these tax administration initiatives impact the different types of businesses processes that exist? So let's walk through this one at a time and start with ERP. Why am I showing you a photo of a kitchen? I often think of ERP migration and the opportunities that exist with ERP migration as a brownfield versus greenfield opportunity. When you're buying a new house, you're building your new house, you're super excited of moving into this new house with all the bells and whistles that come with it. Not many people would then intuitively take down the tiles and the kitchen structure to move into your new kitchen. And the same kind of reasoning goes, albeit somewhat more complex, of course, into ERP migration. Most companies out there have tailored adaptations, complex configurations that have been built up to reflect compliance challenges in a pre-CTC world, in a post-audit world that exists today. Moving all of this to a new ERP system means that you are not entirely well suited to meet challenges of a CTC world or a post-CTC world. It means that the migration projects will be more expensive because you'll carry with it all of these adaptations instead of tailoring it for what we call then a greenfield opportunity that has been from scratch thought out and designed to match the government reform agenda, the challenges of tomorrow. So instead, a much better way to approach ERP migration is to begin already now to address the problems of bad data and why you've customized your ERP system to the way that you've done it today. To take a long, hard look at the different points of origin for data into your financial core so that you can address automation early on and increase the data level before you begin your greenfield migration. At the core of all of this, when we talk to finance professionals and tax professionals, most of the people we speak with describe that the reason for bad data is manual entry points. And it's not just, that doesn't mean one person typing in ERP ledger entries, but there are multiple ones. It goes back to OCR scanning mistakes or different supplier portal entry points with free text fields. The list is long. But the sooner you go about addressing these issues, the longer ahead of an ERP migration, the shorter an ERP migration will be, and you'll be able to instead focus on increasing data quality before you move to a brand new kitchen or ERP system. Now let's take a closer look at the traditional VAT reporting and the new VAT reporting done by or requested by tax administrations. So in the new world order that I've set out to describe to you, what does this mean for your financial reporting processes today? Well, we believe that you'll be seeing much fewer, much less, and less complicated periodic reports going forward. Today, this is the key way of government control in most countries out there. Not just Europe, not just North America, but worldwide, this is the point of origin. This is where governments are starting. They're starting with getting data in periodic reports. But this is also what they want to move away from. This is the entire reason why tax administrations in, for example, Latin America have gone about on their digital reform agenda. Why? Because it gives taxpayers the opportunity to take a period of time, typically from the end of the month when you close your books to the deadline for which you need to submit your reports. And that can vary from country to country. Sometimes it's a month, sometimes it's more, sometimes it's less. But that point of time is a window of opportunity for taxpayers out there to polish and manipulate and improve the data quality and their records. Now, this isn't necessarily a bad thing. In most cases, the only thing that's going on is simply error fixing. But it's not good enough for tax authorities. They want to see the data as close to its original form as it's being exchanged with your suppliers and your buyers at the point of exchange. But as we're rolling out, or as governments are rolling out more and more CTC systems, they don't really need periodic reports as much anyway, because they've gotten all that data in real time. What they will need, and what you will be seeing more of, are e-audit files and e-audit file requirements. CTC systems and continuous and real-time controls allow governments to see data exchanged in real time and great quality of data as well. But it gives them also the tools to perform more audits and to do them on a surgical level. They will know exactly which sectors are prone to VAT fraud, which companies are struggling, which companies have just 3 weeks ago had errors and inconsistencies. So they will be able to choose their audits much more carefully and not just do them based off of the data that has been reported, but they'll also increasingly be requesting file types, for example, SAFT. But Norway, I think, is a great example of a country that says to its taxpayers, whenever we want to be able to request from you a very extensive file of your records, because they also want to see how it's been incorporated into your books. So this is something that you'll be seeing more of for sure. But not just that, you're also going to be facing many of the classic compliance challenges that you're facing already today. Now, this list goes on for long, and I can also discuss it for a long time, but I'm not going to go into this in details. I would say that the status quo on these topics, at least, they remain the same. But what else is new? What else will you be facing? Well, we think that, as I've already briefly mentioned, digital link requirements will increase. And this reflects a desire from the tax authorities out there to see records as they have been booked by you, as core to the source as well, for comparison purposes. The UK's Making Tax Digital project is perhaps the clearest example of such a reform. This means that businesses will need to navigate traditional tax compliance reporting versus operational invoicing, and I'll talk more about that shortly. And also, as a result, with the advent of more extensive reporting files such as SAFT and so on, the lines will be blurred between indirect tax and direct tax. And organizationally, this will become a challenge for businesses, because these people are often sitting in different teams that don't often have reason to cooperate. Tax and indirect tax are, in most multinational companies of a certain type, fundamentally different teams and fundamentally different professionals with different skills. So process-wise and operationally, that will become a challenge. So if we then take a look at how companies can begin to address this. I mean, today what we're looking at in terms of a data population snapshot, what it looks like in the world of most companies for tax reporting today, data enters your ERP systems, your core system, in one way or another, often from multiple different data sources. As I've mentioned, most tax managers out there tend to say that the data that they get is bad in different ways, or it's not of high enough quality. So then what happens is, as I mentioned, you have your in-house compliance teams who spend time typically at the end of the month or the beginning of the next, to fix that data before they report traditional filing to the governments. And in parallel, that ERP system also feeds into your e-invoicing application, so that where there are clearance or CTC regimes, that data is reported to the tax authority in parallel. Typically, these are very, very separate reporting processes, and the same people don't always get engaged across functions. Unfortunately, an opportunity is lost here for most businesses. The effort and time spent by our in-house compliance teams don't go back into feeding and fixing the core data propagator. There is no feedback. So the effort spent one month doesn't go into next month's report. And what this means as a result is that you have the same core bad data that keeps feeding your invoicing solutions, so that you keep feeding incorrect data to the tax authority, or at least data that is prone to errors and risks you getting a high degree of errors and rejection back from the tax authority. Instead, what could be happening, and where companies have a lot to benefit from in the ongoing reform out there, is to apply modern solutions, and there are many at your disposal, that can help ensure that the people who spend all this time and effort in fixing, correcting, and improving errors and improving the data is fed back to the core system that feeds the data source that feeds the ERP system, so that you can automate this process, and over time these efforts spent by the compliance teams can go into more meaningful challenges in, for example, the rollout of new CTC reforms, instead of continuously having to fix the same type of problems, often with the same type or same singular vendors that you work with. It also allows you to, as you standardize and you use these software to put better processes in place, it allows you to get one standard across jurisdictions and across instances and across your vendors. So suddenly you not only have better source for your filing and your e-audit, you not only have the data at your disposal for real-time reporting, hopefully with better data by now, you also have a good common standard to have discussions with your different vendors out there, as well as future vendors, as to what exactly they can help you with. You have a baseline that improves your data and improves communications with different stakeholders. As a result, of course, once you've gone through all of this effort, gone through all of this data improvement, you're facing a greenfield opportunity in terms of your ERP migration or upgrade. So if we take another look now instead at any company's accounts receivable processes, so this typically means your billing processes, many companies out there have chosen to, over the past few years, outsource these types of processes, which is great, of course, and cloud applications have become increasingly popular and increasingly good and sophisticated. But the one inherent problem with multi-tenant environments is that you, as a consumer of that solution, become fully dependent on the vendor's choice of market coverage, country coverage, and compliance coverage. So essentially, you need to make sure that you tackle the tax problem ahead by choosing software vendors in this space, no matter what type of AR process you want to automate, that commit to and help you support compliance in this business. You also need to make sure that you have a certain level of consistency in terms of how they approach compliance, how they approach a bit of auditability, and that gives you a degree of control and understanding as to what they do, what they don't do, and how they help you comply. Now, the advent of e-commerce is a completely different thing in this regard. The principles and the change that I outlined in the early trends in this presentation mean that e-commerce, any type of e-commerce touch point in your AR processes, turns the table on your existing solutions and your existing work. What I've just mentioned in terms of finding vendors that help you comply is ever more important also for e-commerce tie-ins, as so much is changing in this regard. There is much regulatory change going on, and different software vendors out there have different degrees of readiness, of course. And as soon as there is an e-commerce element in your business, many tax authorities have so far not been able to entirely understand what is being sold to where, more specifically, when it's a cross-border transaction. But with these shift in taxability and the shift in other principal decisions from tax authorities, they will now be able to much better and much clearer triangulate what is being shifted from who to whom over which country borders, both due to new directives in terms of customs tie-in and payment data triangulation. Another type of typical AR solution out there, an AR process that affects your business, is EDI. EDI has been a very good way to automate for large multinational companies for many years now, but they are, most of them, of course, not all, are based on principles from a post-audit world. So as this changes, so does the requirements on what kind of data is exchanged through EDI solutions. Governments impose inherent national formats and so on. So it becomes increasingly important to be able to be 100% sure that the EDI solutions you have in place process complete data, complete transactions, that your software vendor is ready, and that you manage original invoice duplicates properly, because as I've mentioned, in some countries the invoice is considered as issued by the system that transmits it through the clearance network itself. So there is a risk for duplicate invoices, which makes this a key contender for systems that you need to look into. But there are more types of B2B transaction vendors out there, and many of them, of course, meet different needs. If you've gone about your digitization journey in a serious and structured way, you will have many different vendors out there solving different needs. And what we recommend is that you do an inventory of what vendors, what B2B transaction automations solutions do you have out there, for what need. Are they country specific? Are they process specific? Are they sector specific? This may vary. And the reason it's important to catalog this is not necessarily for you to change them, but rather to have an understanding of who are your internal stakeholders when you undergo this tax transformation journey, because they might not be aware of the tax challenges that you are facing. And the earlier on you have these discussions with not just your ADI vendors, but your B2B transaction vendors, as well as your internal stakeholders, the better suited you'll be to use tax as a way to accelerate the change curve and as a solution to a problem instead of a last-minute exercise. We further recommend that you, with these internal stakeholders and together with your vendors, have discussions which aim to outline what are we talking about? What does compliance mean for you? When are we compliant? When are you compliant? What do we agree is entirely out of scope of this inherent system in this country? What process is your obligation? What process is our obligation? And ultimately also to agree on whom does the monitoring, who does the implementation, and who ensures the end result. Certainly not saying that the vendor always needs to do everything, because there are aspects of this that will always remain within the remit of an internal tax team. But it's important conversations to be had and not something to be shied away from, because there is a plethora of vendors out there who go about this seriously, or who want to go about it seriously but haven't had the conversation before. With all of these stakeholders at the table, you'll be at a better situation to drive both sustainable and responsible business automation. Now, much of what I've said can also be applied on AP systems, but they are somewhat more complex. Large multinational companies have typically gone further in automating their AP systems because they've suffered more from poor data on the inbound invoicing and inbound data side, which means that there are large chunks of processes that are already outsourced out there. And the type of tax transformation that I've just described cuts across all of these. On average, we'd say that there are about 20 indirect tax requirements in an AP processes per country. Often in some regions, they are more similar. For example, in some of these categories, there is EU harmonization, but in most of them, there is absolutely no harmonization between countries. And there are differences in enforcement as well. For example, in most of the world out there, there are very different rules in terms of invoice archiving requirements, as well as in some countries in the clearance category and CTC bucket, like Chile, there are orchestration requirements from a buyer side to the tax authority, just to name a few. And what's important to note is, of course, that you will, as large companies, have sourced solutions to meet your B2B automation needs, your AP automation needs. And so having a clear understanding of the kind of solution provider discussion that I mentioned for the AR side is also of importance for the AP side because so much more is outsourced. So it's important for you to have an understanding of who does what and what applies in the different processes. And in something as simple as, for example, paper B2B e-invoicing, which is something that is often very automated and outsourced for most companies in post-audit countries. In this case, we're not even talking about the type of CTC reform yet because the evidence is in paper. There are many different types of tie-ins into your AP processes, but there are also many types of requirements. To highlight archiving as an example, when you are exchanging and reading in and scanning B2B e-invoices into your processes. For example, many companies use scanning vendors to OCR the data into their ledgers and into their workflow approval systems. Not all countries allow the 100% removal of the paper original. There are scanning requirements in some countries where it is permitted under clear terms of how you go about doing this. There are rules for how you ensure integrity and authenticity in these countries, and there are rules for how you archive this new evidence of converted paper to electronic form when you want to discard the paper. So essentially, even that's something that looks as a traditional paper process, there are compliance requirements out there. And the sooner you discover what these are and you discover how your solutions handle these, the better suited you are to understand your entire exposure worldwide and company-wide. But we can also take a little bit of a look at clearance side type obligations. Most large companies out there have fairly sophisticated procure-to-pay supplier portal solutions. For example, XML structures is a key component in these solutions. Typically, you exchange one and the same XML document throughout the world. But this, of course, to be able to comply with a clearance country obligation, need to be mapped into a specific format for that given country before they are then tied back into your internal processes. And if we now instead take a look at the fringe processes, when you use not your own, but somebody else's AR or AP processes. Up until now, I've been talking about the solutions that you yourself have chosen to source, or somebody within your organization have chosen to source because they make sense for your business. But there are so many requirements or de facto business requirements for companies out there to become onboarded to somebody else's system of choice, typically your trading party. So if you are a large multinational company, you will and I promise you this, you will have been unknowingly onboarded to your suppliers' AR transactional systems, to your buyers' transactional systems. Why? Because somebody has checked through a quick order sheet to buy a certain product with the terms and condition when they made that purchase to use, say, this specific supplier portal or the specific vendor supplier portal, because that's a company requirement. And if you have, if you're a company of a certain size, it's inevitable that you'll have administrative staff, procurement staff, or sales staff that just want to buy this product or just want to sell this solution, that don't look at this and unwittingly agree to this kind of process. And most likely, there hasn't been any VAT expert sign-off for this kind of portal, and there hasn't been any interoperability discussion with your existing B2B automation solutions. So if you've spent lots of time and effort buying your AP or AR portal of choice, if you've been onboarded to your trading parties, there hasn't been a discussion as to interoperability with your choice solution, most likely. But if you have the kind of discussions that we've already gone through with your vendors to make sure that you know exactly what you do, you make sure that they know exactly what they should be doing, well, then you can, again, take control of this solution to ensure better controls, better automation, and better data quality. If we instead take a closer look at intercompany invoices, now most tax professionals out there feel quite happy about the types of controls that they have for intercompany invoices. That's at least the impression that we've gotten after many years of conversation with key experts in this area and key professionals in this area. Why? Because it's already a well-regulated subject matter area. So base erosion concerns, transfer pricing concerns means that tax professionals keep close look over their processes to make sure that they are complying with these requirements. But in most countries, they aren't necessarily following the basic rules for invoicing. Most of the time, it's instead something that simply exists on the books in a ledger, but doesn't necessarily follow local invoicing requirements. Which is a mistake, of course, because an invoice is an invoice. If it's a taxable transaction, it needs to be documented with its proper invoice. But this protectiveness of the content of the data has often led to this result, that the type of traditional invoicing processes haven't been put in place. And under the current way of tax control in post-audit countries, in Europe, for example, not necessarily all countries will uncover this. But as tax authorities move into CTCs, it's important that you ready your system so that you're able to comply once the world goes into a CTC point of view. Now, instead, let's take a closer look at a component that cuts across all of these requirements, because archiving, as the world turns into a stronger CTC-dominated arena, it becomes even more important than ever before. Archiving requirements have always existed. Some countries have very steep fines. Some countries, the tax authority doesn't necessarily enforce very hard. But if it's an important requirement, which we certainly think already in a post-audit countries, it becomes even more so in a CTC world, because the fact that the tax authority has all of this data in their own ledgers, your business critical information, it is effectively turning the table on businesses, meaning that you need to disprove any type of claim that they put ahead, which as a result means that you need to have better records than ever before. Now, we have over the years talked to many companies who have struggled with basic understanding of where is my invoice. I highlight this because it's an interesting development after many years of outsourcing. Now, we believe that outsourcing of archiving is a good thing, because if you use many vendors out there, if you use multiple AR vendors for increased procure-to-pay, order-to-cash adoption, and that makes sense for your business, then that's great. But we also believe that an archive should, or an invoice should be archived as close to its transaction as possible. that makes sense because if an auditor comes to audit those processes, the invoice will be closely coupled and it will sit close to people who can explain the compliance of this system. But as a result of years and years of outsourcing to process, it means that many companies have to ask themselves, okay, but where is my invoice? I have so many different systems. How do I know which one I can find it in? And this isn't impossible way to solve. It just means that you need to have a clear understanding of what kind of compliance approach your transactional system has. Do they archive, and do they take compliance commitments for that archiving? Now, the last system that I'm going to highlight is tax determination, because it takes directly into your core ERP system. It takes something that has long been good to have into a must. In most countries, improving and having a good tax determination understanding is something that you do for your long-term periodical reporting. This is what the finance team spends time and effort on at the very end of their reporting process. But as CTC affects the world, it becomes an operational necessity. In Brazil, for example, you cannot ship your goods, as I've mentioned, across state borders without a necessary tie-in. And what is important to note that most countries that have CTC regimes, while they today don't necessarily check that the tax rate that you've applied is the correct one, they will. This is the clear next generation step that CTC jurisdictions will take, which means that if you spend time and effort right now improving this, you will be better suited to do this later. So again, the best way to approach breaking the vicious circle and turning it into a virtual cycle is to spend time having tax and IT talk to achieve a good result. Bringing the stakeholders to the table at an early stage is what is the key differentiator for you to be successful in using tax to turn your automation agenda back to the table and make it successful. Together, you can design policies and practices to further this agenda. You can get executive buy-in, and ultimately you'll need to train and coach other functions who have buy-in into these processes so that they can support your long-term agenda as well. We are, of course, happy to help in having these discussions and getting these stakeholders to the table. We've done so many times over the years and describing where the world is going to. So with that, I'd like to say thank you for listening. If you have any questions on what I've said today, then please don't hesitate to get in touch with us, and we'll do our best to address them per email following up. Thank you very much.